Hey, everybody. Thanks for joining us for today's webinar with Jake Kilby. There he is, the doctor. Jake's a contributor with Seeking Alpha, a great friend of the chameleon community. He actually founded a Discord that communicates a lot of information about the market and Market Chameleon and does a lot of great things for the chameleons out there. But before we get started with first call with Jake, let's go through the disclaimer so everyone knows. Market Chameleon, myself, Jake, none of us are registered investment advisors. If you need help related to the markets, please reach out to a broker dealer. Nothing we're saying is advice. So take everything with a grain of salt and as an educational opportunity. Jake, you have anything else to say about the disclaimer before I get rid of it?
No, it's pretty straightforward.
All right, great. Well, Jake, thanks for doing another episode of First Call. We're from the gates of hell, it looks like today, Jake. Where are you?
Yeah, it's been
it's
been a tough time on the markets, right? So it's been pretty choppy last couple of weeks with some downside action on the main indices, S&P 500, particularly tech stocks as well, but nothing I think too worth getting too excited about. Has been the topic of some debates, particularly on the Discord. But anyway, look, to get started,
so, Jake, quickly before, I know we got some new people joining today, some new chameleons.
Sure.
Can you just let everyone know a little bit about yourself? I know you've been active on Market Chameleon for over 3 years. I think you were one of the first people when I was doing the show with my brother Adam. You may have been the first person ever to come onto the chat live when we had like 3 viewers.
Sure. So I'm Jake. I've been a Market Chameleon subscriber for more than 3 years, maybe 3+ years now. And I remember the time when Will used to do the shows with Adam, his brother. And, it's quite interesting to see how the platform's adapted and so forth. I trade my own book. It's what I do kind of full time. I'm not purely US focused. So normally I live in Southeast Asia. My day really is waking up, looking at namely the Australian Stock Exchange and Hong Kong. I don't really trade the Chinese equity markets, but I do trade Japan as well. So it's in the morning, it's Australia, Hong Kong, and Japan. In the afternoon, we get on to Europe, particularly futures contracts and some spot equities. And then we finish off the day really, and the bigger part of the session really is in the US equity market. So if you looked at my book, it would be pretty much a range of things. A lot of options. I would consider myself a full-blown options trader more than an equity trader. I'm not swing trading pennies or anything like that, but also have a pretty big component of futures trading and also FX and a bit of fixed income as well. So pretty broad, not all US, and that's me in a nutshell.
Very cool, doctor. So what are we talking about today?
So today we're going to tie up a few loose ends. I know I mentioned that we were going to speak a little bit about volatility, but I wanted to also do a little bit of a recap because I think that doing a bit of a recap helps reinforce some of the things that you learn and so forth. And then we're going to go and tie that back into the volatility chapter that we saw. We're going to get the chameleon up, the platform, and have a look at some of the things that I do in regards to volatility. But look, tying up a few loose ends, the first thing that we saw many weeks back was Delta, right? And we spoke about the Greeks, and this is specifically about directional risk, right? So delta itself can be defined as a movement in value of your option in regards to a movement in the underlying, etc. Right? So it's range bound from -1 to +1. So -1 means you have an option which is inversely correlated to an underlying, and +1 is you have an option which pretty much performs or behaves like the underlying stock which your position may be tracking. Delta is dynamic, right? So it's constantly moving. It's very important, as I mentioned weeks back, to have a bit of an overview of the aggregate deltas that your portfolio is holding. Are you delta neutral? Are you negative? Or are you positive? How positive is your basket of risky assets? And we saw on the option chain, on the long side for calls, delta's positive. On the long side for puts, delta's negative. And the opposite is true when you swap them around, right? So when you go short calls or when you go short puts, you have positive delta. When you go short calls, you have negative delta. Also a proxy for probabilities. Now, it's not a perfect proxy, but it gives you a rough idea, right? So if you've got an at-the-money call, a long call, which has got 0.5 deltas, then you've got about a 50% chance that will actually finish ultimately in the money. So that's in a nutshell delta. That's the first thing that we covered, just to give that a little bit of a recap. And after that, we had, what time is it? We had the famous time decay, right? So theta decay, which is the daily rate of decline in the value of an option. And what we said was that further out in time, time decay moves slower. And as we get close to expiry, that decay or that time, the loss of value of the option due to time accelerates. It becomes quicker and quicker and quicker. And that's important because that gives us an idea of where we potentially want to be selling options as opposed to where we want to be buying options. I'll give you a perfect example. Covered calls, right? So long equity plus a short call on the top side, right, to generate income. They're ideal 2 to 4 weeks out because that's where you're really capitalizing on that exponential time decay. You're not going to do a covered call 2 years out, right? Because that time decay is decaying very, very slowly. So you don't really get that well, you do get somewhat of an effect regarding time decay. You don't really get that full-blown effect, right? Now, important as well on the long side, so long calls and long puts suffer from negative time decay or negative theta. Now, what does that mean? That means that every day you're holding that option, it's losing value due to the passage of time. And the opposite, once again, is true on the short side. So short calls and short puts, as time goes by, that is positive for your position as things become more and more certain towards expiry. Okay. And then last but not least, we saw volatility and that, or Vega, right? And I call it volatility, makes it a bit easier in terms of Greeks. But this here is, in layman's terms, the huge swings that we will see in an equity or an index or whatever kind of describes volatility. So something which isn't very volatile is a stock or an option or an index which doesn't move very much, and something on the flip side, which is extremely volatile, is something which has huge swings, right? Now, very interestingly, volatility is priced into an option. So if you have a long call or a long put and volatility increases, the value of your option will also increase. So what we're going to see a little bit later on is some trades you can do around volatility and looking at scanners and the like, but very important. And I'd say here, I'm missing gamma because we haven't yet really been through it, but I'd say probably the two most important, Delta and gamma, most definitely up there in the rankings, with probably volatility very close behind, if not meeting or matching both gamma and delta, right? So just here, and I just want to get my little magic marker out. Let's see if this works. But I've taken a little extract from the Market Chameleon. We're going to have a look at this in a little bit. But intuitively, where I want to get you guys is in a space where you can kind of look at delta, gamma, vega, theta, and rho, and kind of already know how your position is going to behave without specifically having to name it. Okay, so we haven't gone through gamma just yet, but the other ones, just by looking at these Greeks here, we have a rough idea what our position is, right? So if we take, let me get my little magic marker out, but if we take here, let's have a look, we've got a delta of about 0.5, so delta's about 0.5, right? Or thereabouts, 45.2. So we know we're roughly at the money. And if we look at Vega here, it's pretty low, right? 1.8, right? So one thing we mentioned earlier on is further out into time, volatility is greater. And as the passage of time comes closer, volatility normally drops or reduces. Now look at these two characters here. We've got, excuse my magic marker, we've got Vega and theta here. Look at the decay here on the theta. So we've got negative $379, which essentially means this option's expiring today. The other thing it tells us, because we're negative there, means we're a long option, right? And just to kind of give you the answer to the kind of pop quiz we've got here, I took this from the Chameleon on Friday at about 3:30, just before, end of play for the whole week. I took an at the money call, and you can see the decay and also that Vega has compressed as we get closer to certainty per se. So here, I've just got a little cheat sheet rule of thumb, right? And these are the kinds of things I use more for educational purposes than anything else. I think I mentioned to you guys earlier, or showed you a cheat sheet, a 2x2 with, the calls and the puts, particularly for newbies. I printed it out and had it on my wall for a while just to kind of get my head around what is a long call, what is a short call, what are the risks involved with those two positions, and likewise for the put side. Well, this here is a bit of a rule of thumb, which gives you an idea of what happens to your Greeks in terms of changes in your option, right? So we've seen a few things, not all of them. We're going to get to them. But if you look at the long calls I mentioned, we spoke about delta. if you're holding long calls, you are positive delta, right? And the flip side is true with, the puts. Now, if you make them short calls, well, that's negative. And if you make short puts, then you've got positive delta. It's an important thing to factor in when you're kind of calculating out the aggregate value of your portfolio. Now, theta decay is negative. Let me just get my little magic marker, sorry. Theta decay is negative for long positions all round, right? So whether you're holding long calls or long puts, time is going to eat away at the value of that option. The passage of time will eat away at the value of the option. And then here on the Vega or the volatility side, positive for both, right? So if I'm holding a long call or long put, it doesn't matter. As volatility increases, the value of that option will increase. And the flip side or the opposite is true as well. As volatility decreases, then my option will decrease as well, which is particularly interesting when you're setting up things like earnings plays, where you've got a vol crush or stuff like that, which we're going to look into in a little bit. Okay, so here's my volatility tools kind of thing, and this is where we're going to get into the chameleon. I've put my C4 here, I think, appropriately, and I'll explain a little bit from personal experience as well. Volatility is pretty explosive, and it's what can effectively wipe books out and portfolios, generate margin calls and the like. So it's something that you need to be privy to, particularly with the newbies. When you work on a volatility position, better to stay risk defined than, naked per se. And also really, really important to understand the risk that you're getting into. So if we have a look here, I've just got an extract from the chameleon. I'm going to flip over to the platform straight away. But two things, implied volatility rankings and vol compare. Let's have a look, first of all, at implied volatility rankings. So where's my chameleon? Here it is, right? So if you click, you put your cursor on options, you can go down and click on implied volatility rankings. And this here, normally what I'll do, I have like some checks and balances I go through when market starts up. And one of the things I'll look at is implied volatility. So I'll sort these normally, right? So the first thing I'll sort is looking at high vol, but I'll also look at the flip side. I'll also look at really, really low vol, because that really gives some opportunity for some long plays, either some speculative long calls or long puts, which are generally less risky than, working on the high vol side, right? So this here will give you a bit of an overview of different positions with, an at the money implied volatility, a 30-day at the money implied volatility rank. And, it'll give you an indication of what's high in terms of screen. The things I'll start looking for, this will be a qualifier, an entry into starting to identify certain prospects or targets in terms of position. The next thing I'll start looking at is option volume and open interest. And then from there, what I would do is, I'm not going to do it here specifically because I need to show some other stuff, but you'd click on the actual stock itself, and then you try and determine what's really driving that volatility. Is it something around earnings? Is it a product launch? Is it a company event? Has the DOJ indicted the CFO? Is there a problem with the SEC? Whatever it may be, but it's very important, I think, before really committing to any volatility play, that you kind of have some form of understanding of what is really generating that volatility.
So what you're saying is everyone has to do their research, right?
Yeah, most definitely. This really is an entry into a trade. It's not the entry and exit. So what I'm not encouraging anyone to do is just look at this and say, hey, cold, ProShares, ultra short, Bloomberg, Nat Gas, 100% volatility. I'm doing short at the money. I'm doing short strangles, because the risk of you being blown out of the water, it's happened to me, and I'm going to share that with you guys as we get towards the end of this. But the risk of you being blown out of the water or having your an adverse event impact your portfolio meaningfully, it doesn't happen very often, but when it happens, wow, you've got to be able to handle it and manage it right, because it can cause sleepless nights. And I'm sure some of you guys have been there already, but what I'm trying to get at is this is an entry to a trade. It's not an entry and an exit. So it's what I would say, a segue into further research, as opposed to being, hey, look, cold's good. That's it, 100% volatility. I'm going for the vol crush. I'm doing short strangles. You need to understand a little bit more about the ETF, what it does, how it's structured, does it use leverage or not, how much does it move, and stuff like that. The other thing, and just linking this together, often, people go straight to the, the vol screen and say, hey, what's high volatility? And often we miss what's really low volatility. And this is where I found personally, you can find some absolutely fabulous opportunities, right? Because low volatility, often you have underpriced options, long or call, long calls or long puts for that matter. And here again, what I'm looking for, not only an IV rank, which is relatively low, but I'm looking for some form of activity in the options, right? So you'll be looking for those two things. And from there, you'd click on the actual stock itself and then start going through. I have a checklist of things that I'll actually go through and sort of like a box ticking exercise. And then after that, set your play up. So I think often we have this perception that trading is sort of like buy, sell, buy, sell, buy, sell, etc. on a position or whatever. A lot of my time is actually spent on the platform doing research, building up a narrative or a thesis, checking it, double checking it, and then waiting for the perfect moment to put that position on. It's not necessarily buy, sell, buy, sell. But there are other people, they do other things as well. But yeah, so let's just
Jake, we did have a quick question, and it's related to Jake's checklist. Trevor's asking, can you share it? Now, Jake did mention he has a Discord. I could put the link to Discord. I'm sure he can share it in there. Would probably be the easiest way. But Jake, I should ask, will you share your checklist?
Sure, it's not a proprietary thing. It's as a pilot does his checklist when he's taking off, I do my checklist when the market takes off, right? So, and it's something that I've developed which suits me, but I'm happy to share it. I haven't got it open right now, so I'm not going to share it live here. But you can either join the Discord or direct message me. It's nothing. Nothing proprietary or whatever.
So Trevor and anyone else, I'll put that link to the Discord in both the Zoom and the YouTube chat. And Jake will talk to everyone who's polite to him on the Discord, and he's super helpful. So I'll put it on and join it on the Discord and reach out to him. And he actually gave you the invite to DM him, which is awesome. Thanks, Jake. I'll get that out.
Yeah, that's cool. No problem. And I'll flip over and show you guys the Discord in a little bit. But most of my research I put on the Discord. I don't really hide anything, and it gives you an idea. Just looking on that Discord, I'll do snapshots of the chameleon. I'll do a little bit of commentary. Hopefully I get a bit of commentary back. If I'm bullish, I'm looking for someone to say, no, Jacob, what you're saying is rubbish. I want, and give me the bearish side of things. But I put a lot of stuff on there. So no problem with sharing that at all. So just continuing on with my little volatility play, the next bit. So we saw, we're going to have a look at these, right? So at the money option straddles, let's have a look, see if we can find that here. So another thing that you can do is, I'm not going to do the straddle comparisons tonight. Sorry. What I'll do is, upcoming earnings analysis. So the other one that I do is this one. Sorry, I'm getting a bit. Okay. So we spoke about volatility and volatility setups, and one of those, which is perfect, or a perfect setup for volatility, is earnings, right? And one of the great things about the platform here is if you actually go on, I'll just show you again, cursor earnings, and then go down to upcoming earnings analysis, you get this screen. Now, you can do, you've got several reports here. So a report over the next 2 weeks, what happened over the last 2 weeks. And you've got some interesting little boxes here, right? And these kind of give you, again, some insights into what could be a volatility play. Now, on the left-hand side, we have currently overvalued implied earnings relative to 4-quarter historical average. And I'll give you an example, right? We've got Levi's, which is reporting earnings on the 6th of October after market close. Options are pricing in an implied move of about 8%, which is about 4% higher than relative 4-quarter average. So if you look over this side here, absolute average move for Levi's has been about 3.7%. The max move has been about 6 or thereabouts, and the min move has been about 1.4%. So straight away, when I see this, and I'll go into a bit more detail with this, but I'm thinking about selling premium, right? But you can do that in a risk-defined way. So that could be, for example, selling, selling a short iron butterfly, a short iron condor, things like that, which will help you capitalize on the volatility crush. So this here specifically, where you've got options which are valued more than implied historical moves, you want to sell volatility, theoretically, or at least you want to look into it. And then on the other side here, you've got undervalued options relative to 4-quarter historical move. And another one here, you can see the top Tilray. I'm not sure if you guys remember the pot super play of 2018 or 2019. I think we had a wave of cannabis plays which were IPOing back then, and there was this huge media hype around them. They're always on TV and bigging up their stocks, etc. And a lot of these companies had mega leverage, no earnings, everything was kind of skittish in terms of their financials or whatever. Well, Tilray itself, I think, went to, and you guys can correct me if I'm wrong, but went to maybe $200 and then came all the way back down. I'm not sure what it's trading at now, maybe $10. But this has been an extremely volatile stock. And what this is indicating to me is options are pricing in an implied move of 10%, when historically the lowest this thing's ever gone is 13%. So here I'd be considering long straddles, and that means not selling, sorry, that means buying an at the money call and buying an at the money put, and hoping that I get enough distance to cover the cost of those two options and some, right? So this is a long play on volatility as opposed to what I showed you on the short side. Now let's have a look and dig a little bit deeper into Levi's, right? So just to give you a little bit of more, I guess, more detail to that. So we've had a look at the upcoming options analysis, and I advise you guys to research these and click through them and see how they've moved and behaved and performed. After that, we've clicked on Levi's, and this here is a great screen, and I use it all the time when I'm doing earnings plays and earnings setups, right? And it gives me a great visual of price action for Levi's around earnings. And again, it's a clue to the puzzle per se. It's not a definitive answer, etc. It just gives me a bit of a hint. But one thing I can see here, just looking at Levi's, is that options have outpriced moves in the stock significantly, right? And there's only been one occasion here on the 9th of July 2019 when the thing blew through the short side. But apart from that, you've pretty much had options outpricing any move in the stock. So if you put your cursor and look at last earnings, 8th of July 2021 after market close, if you put your cursor on the actual bracket, you'll see that the actual earnings move was about 1.4%, and the implied earnings move, that bracket, which is implied by options prices, was about 8.9%. So this is where me personally, and because I think I'll put a position on Levi's, and I will publish it on the Discord with my research so you guys can see it in a couple of days' time or whatever. But this here is something for me where I'd be looking at selling volatility. And you can see it perfectly here. Like, the Market Chameleon does a pretty cool job of sort of identifying potential positions and standardizing stuff. And look at the credit Iron Condor. The win rate on the Iron Condor explains itself by the bracketing of the price action, right? The price action here, like I said, has only fallen through the floor on one occasion. It's never blown through earnings, implied a move implied by options prices before. So yeah, 78%, 13%. Now be careful, right? And what I mean by that is, while this gives you a great rule of thumb, it's not cast in stone. And what I mean by that is, let's look at most recent earnings. You have to link everything to current macro events. And what I mean by that is, look at Nike earnings. Nike went to the downside, reported pretty bad guidance, supply chain bottlenecks and the like, tanked. Well, it didn't necessarily tank, but it definitely went to the downside. We saw that with Bed Bath & Beyond as well. Maybe not the same business, but what you've got to understand is that, earnings reporting at the moment is quite challenging. So you may get that monumental blow through the bottom with Levi's. I don't know. So just food for thought. You always need to weight current events and current news. FedEx is another example. It tanked, went to the downside. Things around supply chain bottlenecks, inflation, stuff like that. So Levi's, which is, I guess, kind of in the consumer discretionary space, probably be faced by similar challenges. You've got to factor them in, or at least give yourself an approximation before diving into any one position. But here I'm looking at this and I'm thinking I'm selling strangles on this, or I'm doing an iron butterfly or something like that. And I'll put that on the Discord once I've actually put the trade on my platform. So let's just keep flicking through. Okay, now this is my Volhard blowout, my blowout sticker. Just sharing a bit of experience, and that's why I put my C4 as well on my slide, is that volatility can destroy portfolios. And I say that really seriously. And I give you my own personal experience. So when I started trading options several years back, one of the first things I started doing, thinking it was a smart idea and it wasn't, was I started, selling puts into earnings. And a perfect example, some of you guys may remember this stock, Align, right? I think these guys do, they're in the dental healthcare kind of space. Stock was trading, I think this is 2018, so this is a ways back, but I think the stock was trading maybe at $300 in 2018. And I thought to myself going into earnings, hey, great idea, I'm going to sell the 200 put. And a word of advice, right? Never point a short option at the market if you don't want to own it, right? Or own the stock per se, because like I mentioned, it can really blow you out the water. Anyway, with Align, I thought to myself, hey, I've got $100 of margin, selling premium for $400. What could possibly go wrong? Boom. We had like a mega black swan event. I think the stock tanked maybe 40%. And just to give you an idea, guys, that $400 premium or gain turned into a $10,000 loss in the space of within 30 minutes. Now, I'm running a sizable book, so it didn't destroy me at all. But what I'm trying to get at here, guys, is particularly if you're running and I think Dimitri reiterates this quite a lot, and I'm trying to do the same. This is all about management of risk. So the first thing you really need to do whenever you're actually diving into any position whatsoever after you've researched it is what could possibly go wrong and what's the max loss I could make. Because if I was running a $10,000 book and I was selling those puts, then I would have completely destroyed my book and I would have had a margin call and closed the account, etc. So super important, super duper important to actually understand the risk you're getting into and understand how explosive volatility can be. So that's my story, going through a position where I was $100 away from the current price of the stock going into earnings, and that's like 30% difference. Thinking to myself, what could possibly go wrong? Hey, I'm going to sell some puts for $400. I wasn't really prepared to own Align as a stock. It wasn't really a stock I was interested in. I just thought, well, I can get a bit of a vol crush, and the thing literally destroyed me. I think is a fair call, and $10,000 down. But since then, look, I've made it back and all's well. But I just wanted to share that experience because we often speak about all the victory stories and victory tales, and nobody ever speaks about the downside and how to manage that downside as well. So continuing on, and I think this will probably be last or second last slide. I wanted to do watch list as well, but I may not have the time. But I also wanted to get you guys into a space where, follow a couple of things from a macro perspective. So you should really be following, and I'm sure most of you are. So the S&P 500, the Dow, the NASDAQ, the main indices, follow US Treasuries, super important, has an impact on pretty much every other part of the market. And also volatility. Now, this is VIXCentral.com. You can find info on the VIX and the VIX curve in many places. But yeah, so this just gives you an idea. And keep an eye on it. It normally trends between 16 and 20 or 30. Anything beyond 30 is pretty extreme. And what you'll find with the curve is when we have a spike in market volatility, at the moment, this is an upward sloping, should I say, futures curve or VIX futures term structure. We'll have the front end spike, and then we'll get into a situation of backwardation, which causes all sorts of market jitters. So that's going to be, I think we're 27 in, so yeah, 28 in. So that's going to be it for today. I wanted to do I wanted to do a bit of a macro overview and watch list, but I think we'll save that for another time.
Yeah, and we're getting you on every couple of weeks during First Call. And of course, anyone can check Jake out every day on the Discord, which I put the link for. Very informative and always very helpful. We did have one question I figure I'll leave you with, because you've mentioned your use of Tasty Trade to me periodically. We had a question from Pavel, and Pavel's a long time watcher of the show, user of the Chameleon, and I think he's maybe on Discord, maybe not, but I think you know who Pavel is. He's saying, what do you think of Tasty Trade's best practices? 45 days to expiration, high IV rank tickers, roll around 20 days to expiration sometimes. And then he goes on to say, this is his opinion. I feel Sosnoff wants us to trade frequently. Shame his traders from the show don't show their best practices. I just wanted to put it all in context of what the question and the comment was. So
me personally, Yeah, I don't actually do. I understand the kind of technique that the tasty traders use. I don't really do that myself, but I've got a lot of time for them. I think they've got a great platform. I think their educational tools are excellent. I've reached out to those guys even personally, and they're pretty, you can get in contact with them and they'll reply to emails and give you their feedback and the like. So I do understand that, there's an agenda behind asking, getting people to trade and stuff like that. But having said that, I think their system and their structure, they understand volatility, they understand time decay, and a lot of what they're doing is geared to optimizing that. So whilst it's not as fun maybe as swing trading ES minis, which is extremely dangerous, of course, but it's a swing trading, it's not fly by the, seat of your pants trading. What they're doing is kind of structured, boring, but kind of works in terms of their system. I don't use it. And it's not because I don't think it's a good system. I just, I have a broader, what I would say is I use a lot of different tools. I don't just have one tool. And I don't think there's one tool which suits all things. So, I'll do earnings plays and I'll use everything. I'll do long calls, I'll buy equity, I'll do covered calls. I'll use pretty much everything which is available to me rather than sticking just to that tasty structure. But yeah, it's pretty good. I've got a lot of time for them.
Yeah, well, I agree. I think Tasty Trade is an incredible product, and their videos are a great resource.
Yeah.
But like Dimitri says, I mean, myself, Dimitri, we look at every trade individually and do our research on each trade. And as the trade changes, our thoughts. So I know this practice works for some people. We've had people come on and mention it. So I think you have to find what's best for you.
Yeah. Just quickly, guys. This is the Discord, right? And so this is me, and I give my research, and it shows you exactly what I'm doing, right? So a perfect example, $46 call standing out an MGM, and I explain why. I normally circle it, and I often, sometimes I'll put a position in, sometimes I won't. And I'll also give some macro information, particularly because I'm up earlier in the morning than you guys are. I'm trading Asia and I'm also trading Europe, so I'll give you a bit of an overview. I follow Bloomberg all the time as well, so. Please get on the Discord. If you think my idea is a bad idea, tell me why. That's the whole point of it, right? To exchange ideas and have the opposite side of the trade as well.
Now, we had one last question. Someone's asking, what time is your show? Now, it's 10 a.m. today. We just put it on. You didn't mention another show, right?
No, I don't do any. The only show I do is my first call with you guys. I don't actually, I don't have a YouTube channel or anything like that. This is all I do, and it's enough for the time being. I'm enjoying it.
Yep, and we try to do it every couple weeks. This show, so sign up for the emails. You'll get alerted to the show. We do have a morning show, which Jake, he's on quite a bit listening. But he does occasionally bring a great question and actually comes on live periodically if he can. And we do that every trading day, 9 to 9:30. That's run by Dimitri, but I am on it as well. And we have a great community that joins us every day. So that's cool. Jake, someone's asking, are you on Twitter?
I certainly am. Yeah, I'm not as active on Twitter as I used to be, but you can find me at Reanimator. You can also, if you click on me on Discord, it actually comes up as well. So hang on, if I click here my profile, there you go, Reanimator. That's me there, right? So you just click on the right click and you've got, a little bit about me. And MK Capital is the kind of, that's the brand I use for my Seeking Alpha posts and stuff like that.
Which I think I mentioned it. The Seeking Alpha articles are great. Everyone should follow Jake on Seeking Alpha. Unfortunately, I don't have that link readily available, but search Seeking Alpha for MK Capital. And obviously, it's not a show, but Jake is on Discord every day. So get over to that Discord. You can hear from Jake. You can get his comments, and he actually gave you the ability to DM him, which is incredible.
Yeah.
Jake, thanks so much, my friend.
Yeah, no worries. And just one last thing, like I said with the Discord, get in there, get active. I'm happy to share my experience on, whatever, whether it's a direct message or a call on Discord, it's got voice, video, whatever you want, whatever you're comfortable with. And I can, share stories with you, and you can share stories with me as well. And hopefully as a community, we can kind of become better traders.
Great job, Jake. Thanks for bringing it, my friend.
No worries.
All right. We'll see you in a couple of weeks. Thanks, everyone, for joining. Have a great trading day. Bye.
Bye.